Keynes' theory of employment and income. Keynes' book, that's the General Theory of Employment, Interest and Money, which was published in the year 1936, paved a turning point for the modern economic theory. This theory was against the belief of classical economists, which had the market force in the capitalist economy to adjust themselves to attain equilibrium. So Keynes not only criticized classical economists but advocated his own theory. So Keynes' theory was a general theory. It tried to explain all types of situation, not only equilibrium level of employment but also the concepts of full employment as well as the possibilities of underemployment also. So Keynes' theory of employment was based on the view of the short run. So according to him, the factors of production such as the capital goods, supply of labor, technology and efficiency of labor remains unchanged while determining the level of employment. John Maynard Keynes. Now we know that Keynesian economics is a macroeconomic theory of total spending. Keynesian economics was developed by the British economist John Maynard Keynes during 1930 in an attempt to understand the solution for Great Depression. Keynesian economics is considered on the demand side theory that focuses on the changes in the economy over the short run. Keynes' theory was the first sharply separated the study of economic behavior and market based on the individual incentives from the study of broad national economic aggregate variables. Effective demand. Effective demand means the level of employment in a capitalist economy depends on the level of effective demand. That means by effective demand, Keynes meant that the total demand for goods and services in an economy at various levels of employment. Total demand for goods and services by the people is a sum of total of all the demand meant for consumption and investment. So in other words, we can say that the sum of consumption expenditure and investment expenditure constitutes effective demand in two-sector economy. In order to meet such demand, people are employed to produce all kinds of goods, both consumption goods and investment goods. However, to complete our discussion on effective demand, we need another component of effective demand. That's the component of government expenditure. Thus, effective demand may be defined as the total of all expenditure, that is C plus I plus G, which stands for consumption, investment and government expenditure. Here we ignore government expenditure as a component of effective demand. According to Keynes, the level of employment is determined by the demand, which in turn is determined by the aggregate demand function or aggregate demand price, and aggregate supply function and aggregate supply price. Aggregate demand. Aggregate demand is an economic measurement of total amount of demand for all finished goods and services produced in an economy. So that's why we call it as aggregate. Aggregate means the total amount. Okay, aggregate demand is expressed as a total amount of money exchanged for those goods and services at a specific price level and at a given point of time. Okay, so aggregate demand consists of all consumer goods, capital goods, exports, imports and government spendings. So aggregate demand represents the total demand for goods and services at a given price at a given point of time. It is taken for a long period and it is equal to GDP. We can say that aggregate demand only is equal to GDP in the long run after the adjusting of price level. So the four components of aggregate demands are consumption, investment, demand, government expenditure, and the net export. The desired or planned demand is the amount of the household firms and the government and the foreign purchasers would like to spend on the domestic output. So aggregate demand is can be explained with the help of a clear picture of a diagram. Now just look to the diagram given below. OX is the level of employment and OY is the aggregate demand. So in this diagram, it explains that the aggregate demand price increases or decreases with the increase or decrease in the volume of employment. So aggregate demand curve increases at increasing rate in the beginning and then increases at decreasing rate. So this shows that as income increases owing to increase in the employment, expenditure of the economy increases at a decreasing rate. Aggregate supply function. Aggregate supply is determined by the physical and technical conditions of production. However, these conditions remains constant in the short run. As such, given in the technical condition, output is the short run can be increased only by increasing the employment of labor. So aggregate supply, or what is it's called to be aggregate supply price, is the amount of total receipts which all the firms must expect to receive from the sale of output produced by a given number of workers employed. So it can be easily explained as aggregate supply price is the total cost of production incurred by the producer by employing a certain given number of workers. So this can be understood with the help of a diagram. Aggregate supply curve. Now aggregate supply price is the total amount of money that all entrepreneurs in an economy expect to receive from the sale of output produced by a given number of labor employed. The term price refers to the amount of money received from the sale of output. Hence, there are different aggregate price for a different level of employment. So it can be classified under four different components. 1. Aggregate consumption expenditure, that is C. Aggregate private saving, that is S. Net tax, that is T. And personal transfer payments to the foreigners, that is RF. All these components are aggregated to aggregate supply. Aggregate supply is equal to C plus S plus T plus RF, that is the foreign transfer payments. So aggregate income generated in an economy. So this is explained with the help of an example of a diagram which is shown in the shape of two aggregate supply curve drawn in the assumptions of fixed money, wages and variables. In this diagram you can see that Z is a linear where money, wages remain fixed. Z1 curve is a non-linear since wage rate increases with employment. When full employment level of NF is reached, it is impossible to increase output by employing more men. So aggregate supply curve becomes inelastic, that is vertical straight line. Okay. The slope of the aggregate supply curve depends on the relation between the employment and productivity. So here it is based upon the relation that the aggregate supply curve can be expected to slope upward. In reality, the supply curve will be like Z1 which is given in the figure. Therefore, the aggregate supply depends on the relationship between price and wages. If prices are high, wages are low, and the producer will try to employ laborers. If prices are low, wages are high, investment will be curtailed, output will fall, and there will be a reduction in the productive capacity. So you can see that this is a circulatory flow. So this aggregate supply is an important factor which determines the level of economic activity.